Hey, this is Matt from InvestiQuant. Today is Wednesday, October 27, 2021. And before I get started, I just wanted to give you one last reminder that today after the close at 4:30 p.m. Eastern Time, we'll be hosting a webinar about short time frame trading, the shorter duration strategies that we like to use here at InvestiQuant. So if you are available after the open, if you register here, there's a link below this video where you can come to this page, fill out your name and email. We'll send you the link to join us in the webinar. We'll be talking about things like crisis correlation, short duration strategies, and why most traders don't make it. So there's a couple good reasons for that, and we'll go over that and how you can avoid those pitfalls. But that'll be after the close today and at 4:30 p.m. Eastern Time. All right, let's hop into our study for today. We are going to be looking at what has happened historically when you get a 52-week high close like we had yesterday, but you do it with a red candlestick. So yesterday closed below the open, making a red candlestick on the day, but it still closed up at 52-week highs. So we're still marching higher, but yesterday closed weak. Let me go ahead and set this up. We'll be using all four instruments to set up based upon entering the market long at the open of regular trading hours, which is 9:30 a.m. Eastern Time, exiting at 4:15 p.m. Eastern Time. Now for this study, right now we are trading flat, completely flat. I have no idea if we'll be gapping up or down, and it does kind of make a difference, but I'm going to leave it out for now. You can do this on your own later if you want to add an opening filter to it, and I'm going to create the price pattern by going into the price pattern. I'm going to say that yesterday closed below the open. That's from this last open and close here. I'm going to hit equals next to close below the open, and then in the new high section, I'm going to say yesterday closed at a 52-week high close. That's just below here. I'm going to hit equals. That'll add it to the test. Now I can click view results. All right, here we go. These are the results based upon entering the market at 9:30 a.m. Eastern Time, exiting at 4:15 p.m. Eastern Time when the prior session closes at a 52-week high, but it does so with a red candlestick, meaning it closes below the opening print. Historically, we've got 79 samples in the S&P, 68 in the NASDAQ, 76 in the Dow, 40 in the Russell. The win rates on these are all very neutral. The S&P coming in at 49%, NASDAQ 53%, Dow 50, and Russell 55. So not much of a bias there in the win rates on this pattern. If we look at the average moves, pretty similar in size. The average loss is a little bit larger for the S&P. The average loss is larger for the NASDAQ. The average loss is larger for the Dow, and it is larger for the Russell. So the moves have been bigger to the downside following that pattern. But as far as win rates, they are very neutral. Now, one other thing that's more interesting with this pattern than these very neutral readings here is switching this pattern up into a day trading setup. So looking at this as a gap fade. So let me go to trade type, click on gap fade here, or fade from the trade type, and then change the exit targeting the prior close with a stop. And I'm just going to throw a random stop on here. I'm going to use 40% of the 5-day ATR. Current 5-day ATR in the S&P is about 29 points, so 40% would be 11.5, 12 points, somewhere in that ballpark. But this will be targeting the prior close, which is a gap trade. So if you're gapping up, a fade towards the prior close is going to be a short. If we gap down, meaning we open below the prior close, a gap fade would be a long, and it would be targeting the prior closing price. And I'm also going to go to the opening filters, and I am going to throw a minimum gap size on this. You can do that several different ways. I'm just going to do a simple one here. I'm just going to say the gap has to be at least $50 worth of a gap if you're trading a single contract of the instrument. So for the S&P, that means 1 point. I could also type in 1 point here in the gap size by points. It gets you the same it'll get you the same results either way, though. But that's just going to get rid of the trades that aren't really tradable. All right, let me go ahead and click View Results. And here we go. So we get the same amount of samples as we did doing the end of day trades, but now all of a sudden we've got win rates on some of these that are much more attractive and decent average trades on a couple of these. So let's take a look at the win rate on the S&P using this gap fade strategy, which is based upon entering the market in the opposite direction of the opening gap. So if the opening gap is down, you're going long. If it's up, you're going short. For the S&P, those 70 samples has a 64.2% win rate. For the NASDAQ, it's a 57% win rate. The Dow, 67% win rate. And the Russell, 73% win rate. So win rates not bad on those for a gap fade strategy. And you can see the equity curves on them get quite a bit more attractive. This is the S&P equity curve here. This is the NASDAQ. NASDAQ looks like it hasn't worked very well. The Dow, pretty similar to the S&P. That one's generally been favored, and the Russell favored as well. Not quite as strong, but this may give you an idea to play around with as we get closer to the open. You obviously don't have to trade it exactly like that, but it may give you an idea to be thinking about perhaps taking gap fade strategies or trading towards the prior day closing price somewhere around the open. So hopefully you found that helpful. Hopefully we will see you this afternoon. Good luck today. We'll see you next time.